Excellent. But now we spent enough time chatting. I think all of you participants are here eager to hear part 2 of the lecture series on the introduction to quantitative finance. Sorry for the slide today in the start. Load shedding is beyond our control. Yeah, Mesias, thank you very much for being with us again. Please, you already started sharing your screen, just go. Because people are eager to learn more. Yeah, please, thank you very much.
No, thank you, Francisco, and thank everybody for coming to lecture 2 on Introduction to Quantitative Finance. So today we will jump into the real stuff of financial derivatives. So this lecture, we're mainly going to talk about what is the financial derivatives, what are they used for, and then we will really, before we go to financial derivatives, there's a lot of nitty-gritty things that we need to make sure that we understand, especially that we need to understand what is the market uncertainty, what are the probability theory and measure theory concepts that we need to know in order to understand how to deal with derivative security. Okay, so in my agenda, so we're going to talk about the market uncertainty, the portfolio trading, and also some other trading strategies that are used, as well as forward options and other derivatives. So these are the outline of my talk today. Like I said, before we talk about what is really a financial derivative we need to understand what are the market uncertainty, the trading of financial instruments in the financial markets, and so forth. Okay, so let's define the variables first. So we consider a financial market in which a financial market is a market in which you can trade some, say, basic securities. These basic securities are, say, for the instance, the stocks, the bonds, or maybe stock indexes. So we can treat them, and we denote the prices to be S, meaning S subscript 1 is the stock price or asset price of that for 1 up to N. So we fix the time horizon. This time horizon is the trading time horizon, say from today, which in many circumstances today we normally denote it by small t equal to 0, is now, and the investment horizon is up to capital T. Okay, so we can either distinguish between two time description. We can either describe the date as discrete, meaning you have a discrete point, or maybe we can say in a continuous time when you have from 0, meaning at any continuous time up to capital T. This capital T, like I said, is just a finite time horizon where we're doing all the market activities like investment or maybe trading of maybe some basic securities. So then when you have an asset that you are trading, or maybe you are dealing with a particular asset or stock or maybe bond, the present value of this price of this asset, we know the present value, but we don't know what will be the future value of this asset. So now, if you look at the evolution, so today we know the asset price, but the trajectory of these prices, it can either go up of this asset, it can either goes up or down, depending. But so the evolution of the market price of this is what we call the market scenario. So it's what we call the market scenario is the evolution of the market price of this basic security. So the market scenario is specified in the evolution in time. So of course, if now you do not, this is the asset price for the asset I at time t for all the times in your or time horizon, okay, for the basic securities from I equal to 1 up to N. So now we introduce a set of these market scenarios, a set of all these market scenarios of the evolution of your stock price, or maybe asset price to be more general, is called the capital omega. And then an element in that market scenario set is called the market scenario only. So if you look at omega, small omega, if an element of that is what we call it, denoting the market scenario. Then if you look at, say, one stock, if you look at one stock price, which is denoted by S at time t, meaning t is just an element of this time horizon. And then we consider now the positive values of those stock prices, which can take value. So like I said, capital omega, this is the set of function which is defined over the time horizon, capital T, meaning if we consider now the stock prices that are taking only positive values, meaning values between 0 and infinite, and this set now is known as a set of strictly positive sequences of your stock prices. So strictly positive. So now we introduce, but very basics, but for those that are really interested, you can look at any book on stochastic calculus, but as an introduction, we have what we call the measure and probability theory. So if you consider an event A, an event happening, is a collection of market scenarios. So meaning A, if it's an event, is a subset of these market scenarios, or this set of market scenarios. And this script F is a set of events that also part of this market scenario. Okay, so like I said here, an event is a collection of scenario, and A is just a sub, which means it's a subset of this capital omega. So we have an omega, which is a set of all this market scenario. Then we need to know what is a probability measure. If you look at what's a probability measure on this now set of scenario, a probability measure is a map that taking value from this set, meaning from this set up to assigning real values between 0 and 1. It's meaning it's taken from this set collection, which is a subset of all market scenario, up assigning a number between 0 and 1, meaning it's a map from a subset of the market scenario, giving a probability and a value, which is a real number. Meaning a probability, if A has a probability of 0, it means it's a null set, or that means it's an impossible event. If A has a probability which is equal to 1, then we say that A is certain, or what we call sometimes almost surely. And of course, P verifies that the probability of an empty set or a null set is equal to 0, while the probability of all the market scenario set is equal to 1. And also for any element of this set, meaning A is an element of the set, we know that the complement, the probability of the complement is just given as 1 minus the probability of that set, which means it's 1 minus the probability of A. And if we have disjoint set, if you have disjoint set, meaning the intersection of this, the intersection is a null set, like it's given here. So this is the intersection of I and J, which I and J are not the same, is equal to an empty set, meaning the union, the probability of the union is the same as the sum of the probability of the individual set. So this is just some basic properties of the probability measure. Okay, then now it's important to know that the script F is not a collection of subset of capital omega, which is the market scenario. Please make sure that you know that. The script F means it's a set of events for which the probability this probability can assign a probability for the event which actually satisfy all these axioms. Okay, the first axiom is that an empty set and the whole set are part of that set, script F. That is closure under complement. That means for any set A which is in that capital F, meaning the complement must also be in, meaning omega minus A must be in that script F. Is closure under countable union. That means for any sequences of events in this F, meaning the union must also be in that. Meaning now, if this F satisfies all these three axioms, then we say that this F is a sigma algebra. Okay, so, and this F is a set of events for which we can assign a probability if it satisfies all these axioms. So this is what we call the sigma algebra. Okay, where are we headed to? We headed to getting, because we need to know the process and we also need to know the information exploring in the financial market. So we want now to go to the next point is we're going to talk about the filtration, or what we call the increasing sequence of sigma algebra. Okay, so now I think we know now that if this subset of market scenario, which it satisfies all these three axioms, then we call this F to be a sigma algebra on that set. Okay, next, we denote a stock price. The stock price, say, okay, to be more general, say an asset price, which is denoted by S, meaning asset price I at time T under a scenario omega. It's the price of an asset I at date T in this time horizons for the scenario W in omega in capital omega. So this is a price. This security price now varies across time and also across market scenario, meaning it can be represented as like a random process. So this is a function which has a cross product between, so this is the market. It depends on the time and also it depends on the scenario. And it measures, output is a real number. So this map from this set to a real number, this is what we call a random process, or what we call the stochastic process. Okay, in a nutshell, so what happening here is that if you look at the asset price today, we cannot, okay, well, you can predict, you don't know what is actually the value for this asset price tomorrow or the following day. So we regard this trajectory as of an asset price or a price of an asset or maybe of any security to be a random process. And a group of this random process is what we call a stochastic process. Okay. Then we come to this, what we call the filtered probability space. If you look at most of the standard textbook on stochastic process, you always see this quadruped. So it consists of this, which is a set of market scenario, which this one is a set of all possible events during the time horizon. And P is a probability that assigns probability to events that have happened. So this set, this one here is called the probability space. Okay, so again, this is the time horizon, capital T, and the security price is normally denoted by S. I denote a particular security, and then now we define a subscript, F subscript F at time T, meaning a set of events that are observed at time T, at a small time T. So again, we go on and then look at what are the properties of this subscript FT. Then, script FT is actually a sigma algebra, meaning it satisfies all those three axioms that we've spoken about. And this script FT is a subset of this sigma algebra, the non-sigma algebra, meaning it contains only depend on the past information up until at a particular date T. Say we are standing at a small time T, meaning it's a subset of F composed of all events which have depended on the past up until the present time or up until date T. Meaning for any T2 bigger than T1, we are guaranteed that FT1 is contained in FT2. So that means if script FT is a sigma algebra, meaning now this is an increasing sequence of sigma algebra. And this is what we call F-filtration. F-filtration is an increasing sequences of sigma algebra, and this is what it gives us the information whether a process, whether you know the value of a process or not. So in view of at the T, an event in FT is certain, meaning it has either happened or not happened. We know the value or not, meaning now this capital FT gives us the information about the process, about the value of the process, whether it has happened or not. Okay, are we all together? Let me see if there are any questions. No serious questions so far. Okay. Then, so this is just what I'm trying to define again. A formal definition of what we call the filtration is an increasing sequence of sigma algebra in a nutshell. So it means for all T, the script F is a sigma algebra, and for all time that are coming area, the FT1 must be contained in FT2. Okay, intuitively, FT or script FT represent the information known up to date T, small t, right? And any information known at T corresponds to an event, say A, in that sigma algebra. So now the random process X, which X, this one, is said to be non-anticipated, anticipative, or what you call is adapted, meaning we know, or we say is FT adapted, meaning we know the value, or we can compute the values from the information that we have. So we say the process is non-anticipative if the value of xt might be computed from the information, which is the sigma algebra, which is known at the t. Okay. Now, so now what we do, if we define a market scenario, which is the path of asset, then we can say, because if this path of asset is it's adapted to the fluctuation, then we say this process here is non-anticipated. But now, if we look at the process pay, for example, if you have X, which means it's a stock price tomorrow, we don't know what's the value tomorrow because we only know the FT only for today. It only have the FT is this one is not FT adapted because it looks at tomorrow. So tomorrow we actually don't know what's the value for this asset or this stock price. So in this case, we say that X is not adapted to the fluctuation. It's not FT adapted. So that's okay for now with the introduction to probability theories and measure theories. Now let's look at the portfolio. A portfolio, you have sort of investment. A portfolio, just like an investment, is denoted by phi, meaning you have many different, you have a lot of investments, say up 1 up to n. And this phi I represents the unit of asset in I's investment. Meaning, if you say you put money, some money in the bank account, some maybe in the stock, some maybe in foreign trading and so forth, those are like your phi 1, phi up to phi n. So we normally denote phi 0 to mean the cash that we put in a bank account. Usually S0 is equal to 0. I mean, is equal to 1. So if you have this investment, now at time T, meaning at current time, or maybe at some time, arbitrary time, the value of your portfolio will now be given as a sum. So now if you look, so what you invest, how much times the value, how much, or these are sort of like your weights, the weights of your investment, and then times the stock price, or what is the value of your investment security. And this is what you put in a bank account. Normally this one is equal to 1. 8 times 0 is always 1. Okay, there are two terminologies that are normally used in financial markets. So a long position and the short position. Normally for a portfolio, if the weight, this number of units in certain asset is positive, we saw you have long position. So it's a position of holding security I. Investor has, that means you have bought. So long position is just say you have bought, and the short position, it means that you have sold, or you borrow to sell, or maybe and normally this is negative. And then we say that a portfolio is short, meaning or you sell this number of units of stock or asset. Okay, please take note of this because this becomes very it's very popular in the financial market for terminology, long position and the short position. And then we come now to the main core of this lecture, which is the financial derivative contract. In a nutshell, the derivative contract, the financial derivative contract is those financial instruments whose values are derived. That's why the name derivatives are derived from another underlying basic securities. Like the basic securities that are most popular are stocks, bond, say stock index, currency, maybe agricultural products, maybe crude oil, gold, commodity, and so forth. Those are known as the underlying security. Those are the basic security. If you now consider another financial product whose values depends on those basic security, this one here, then we call that is a derivative security. So the underlying is S, but Take note, by saying S, we don't really mean stock. S is arbitral in this case, in this sense. It can mean stock, it can mean bond, it can mean stock index, and so forth. So what is a formal definition of a derivative contract? It is a financial contract that pays at time T a sum. That sum, we call it a payoff, which depends on the behaviors of the underlying asset S during the life of the contract. The life of the contract is initiated at time 0, and time T is normally what we call the expiration time of the contract, or the maturity time of the contract. So in a nutshell, a financial derivative is a contract whose values are derived from another underlying asset during the life of this contract. Okay, we denote H to be the payoff, and then the payoff is normally realized at maturity time at capital T, meaning the payoff H depends on the underlying asset. So that's why we say this is a derivative, because the payoff depends on the trajectory or the behaviors of the underlying security. Okay, so again, I'll go through why are the derivatives popular. The derivative is a financial contract whose value is derived from another underlying asset or variable, such as stock price, or the level of index, or the level of interest rate. Example here, the stock options values depend on the value of the underlying stock. The price of a zero coupon bond depends on the prevailing interest rate. So we say a zero coupon bond is a derivative. Or maybe profit and loss made by buying oil future depends on the change in the spot price of the oil. So those are sort of like an example of derivatives. But why are the derivatives so popular? They are popular because they are used for hedging. Hedging is to prevent or to minimize the risk. That's what we spoken last time. And also speculation. You use the derivative security to speculate that maybe the price will be this in the near future. So essentially, derivatives are tools for transferring risk from one entity to another entity. And these derivative securities have been some of the ones that they've been playing a popularity since during the global financial crisis, and they were misused. Just read up some of the articles on how derivatives were misused. And there's another third part, which is called the arbitrager. Arbitragers are those agents in the financial market that are just there to take up offsetting position because they want to take arbitrage opportunity. They want to make sure that they make money from nothing. But all this will come out clear later. Yes. Any question? Let me see. Okay. There's one question, but I'll come back to this. Let me just make sure that we go through this. Okay. So. Okay, from here, so the derivative securities are used for hedging, speculating, and also arbitrage. Arbitrage are one of the types of market agents who use a lot of this. Okay, then we look at what are the types of derivatives. There are many types of derivative securities. And the first one, the basic one, is the forward contract. A forward contract in a nutshell is that it's a derivative contract. It's a contract where the underlying asset is S, meaning a forward contract, you say, on Friday, this Friday, I want to buy or maybe I want to sell, I want to buy this asset, but I don't know what the price of this asset be in Friday. So I enter a contract, say, so let me buy this product at 50 Rand. But whatever the value of the asset on Friday, I'm only going to buy at this 50 Rand. So you are obliged to make sure that you buy the asset on Friday. You are committing, it's an obligation. So here, so you are standing here, a capital, a small time T, this is a maturity, a forward contract on an underlying asset F with maturity capital T and a strike price. A strike price is what you are agreeing today to go and buy this asset on Friday. So whatever, even if the price on Friday for this particular security is 20 Rand, you are still going to buy that asset on 50 Rand because you are obliged to exercise the contract. So that means the value, this is now for the long, is now going to be whatever the value, this is a payoff minus K. So this is now the value. If K is what you agree today to go buy the asset. So it represents an agreement between two parties, a buyer, which means a long position, and the seller, a short position, to exchange at time T, to exchange an asset at time T for fixed price K. Does not require to hold the current, to hold the underlying asset. The value, and this is important because you are obliged to buy or to exercise the contract at maturity. The value of this at time 0 is 0, meaning you to enter that contract, a forward contract, it requires no premium. No, you don't have to pay anything. And the cash flow is given as ST, meaning this value ST is what's the value of the underlying asset at maturity minus what you have agreed to go buy the asset. And then we look at what we call the European. Like I said last time, the European are types of option of which you can only be able to exercise or to realize the payoff at maturity. So those are called the European. So we have the call that allows you or give you the right to buy, and we have the put that give you the right to sell. Okay, a European call option with the underlying asset S and maturity T and the strike. So that means it gives you the right to buy one asset, one unit of asset at a particular time in future capital T at a price K. But now the difference between a call and the forward contracts that we discussed, this only give you the right. It gives you only the right, but you are not obliged to. That means the maximum, the payoff at maturity, which is denoted by H, is a maximum between the final value and K. So now that means here for all the ST that's less than K, here ST is here, you see that it's all 0 because it's taking the maximum. But as soon as ST be bigger than, you have a payoff, which is positive payoff. And a call option, it gives the insurance against the rise in the price, while the European put option, it gives you the right, but not obligation to sell an asset at capital T, which is a maturity time. And here, you're going to sell it at K, at the price which is known as the strike price. And again, the European put option gives you the insurance against the falling of in the price of the asset. There are two, again, I'll go through this. There are two terminologies that I use: long call, short call, long and short, or long, short, long, short. What does it mean? What does it mean? It means if the investor is long call, it means you realize the payoff, which is ST minus K, and we normally put plus. The plus, this means it just take the maximum. If this is positive, then you take, if it's negative, then you take 0. It's the right. Again, like I said, it's not obligation to buy an asset at time T with at price K. If an investor is short, that means now has sold a call. And in this case, if the investor is short a call, you are obliged to make sure that you sell an asset at price K. And in this case, the payoff is negative. For the put, a long put, meaning you have the right to sell. But again, it's not an obligation to sell at time T at the price K. And in this case, the long position in a call and a put are always positive at maturity, like I said here, to enter the contract. And again, this is also very important to know the difference between the call and the options and forward. Here, because at maturity time comes the maturity date, capital T, you realize that you don't want to exercise, you don't want to exercise the contract, or meaning you don't want to, if say you agree today to buy an asset at 50 rand, then come on Friday, the asset price is 30. Why should I buy on Friday? Why should I buy an asset on 50 rand when I can actually go to the market and pay 30 rand? Then you can say, you can decide that you don't want to exercise that contract. Because of that flexibility that you have, that at maturity, you have an option to say, no, you don't want to exercise. That means to end that contract is not for free. You have to pay a price, and that price is called an option price, or what we call the premium of an option. And that is what made up financial mathematics, or what made up quantitative finance, because we want to find out what is a free and fair price, or what is the free and fair value of this price of an option contract. This is the beginning of financial mathematics. Okay, so now we go through again. So these are the major underlying stock, or maybe underlying security, like major stock index, stock, currency, bond, and commodity. And some of the most standard exchange, like Johannesburg Stock Exchange, also is one of the that trade options. We have also London International Financial Exchange with Chicago Mercantile Exchange, and also Chicago Board of Option Exchange. Those are one of these. Also in Australia, we have Australian Stock Exchange that also do trade options. And so far we only discussed two types of the basic options, what we call the European option. And again, there's other types of options that are called American stylized option. The difference between American stylized option and European stylized option is that American stylized, you can exercise, you can decide to say, no, I want to exercise my option at any time before maturity. But for European, you have to wait until maturity time. So we also have some other options that are called exotic options. Exotic options are the ones that are probably have complicated features. Probably they are very important for hedging, but they are not really popular, but they can be very beneficial, especially if you include it in your hedging strategy. So path-dependent options. Path-dependent options are the option, if you look at the underlying, if say the maturity of your underlying is 1 month. So every day the underlying price goes up and down. So path dependent, it means at maturity time, the payoff would depend on the trajectory, on the past trajectory of 1 month of that underlying asset. The most basic, the most common path-dependent options are like Asian options, like I said, Asian, now in this case, Asian does not mean anything has to do with geographical location. Asian option, it means that an option that when you evaluate the option, it depends on the average of the path that's been taken by the underlying. So that means for an Asian call, it's an average of the path minus the K, which means the strike price, and again a plus just means it's either taking this value, if it's positive or zero. And this is the Asian put option. And this is common in commodity market. Then we have what we call barrier option, and I like this barrier options. So you set it up like we have a lot of types of barrier option. We have about 8 combinations of them. So you set up your barrier, your barrier line. You said if the underlying asset goes beyond that barrier, then we call it the option is knocked out, meaning it ceases to exist. So those are called knocked out option, meaning if your underlying, your target, if you put your barrier line somewhere, then your underline is going up and down. The moment that it hits that line, that barrier, then the option ceases to exist. So because of that additional constraint, barrier options are normally cheaper than the original European stylized option. Okay, the payoff. Okay, so now this again, they are mostly common in foreign exchange, and the payoff is given like for a put is K minus ST. If during the life of option, ST is bigger, meaning it doesn't cross that barrier. Now in this case, you say is down and out. Is down and out option or put option. And then also we have a knock-in option. Knock-in option. So if you have your barrier line, if your asset price doesn't close that barrier before maturity, then it ceases to exist. Meaning it has to hit the barrier for it to exist. So now knocked-in option is a call with a strike K and a maturity T, trigger as soon as underlying reaches the option that now is written like this is a payoff. So now, so this can only be, it becomes a call option as soon as your maximum is bigger than your barrier line, which is you. We also have other options which are called corridor option. The corridor option, it just means that so you have upper bound and the lower bound. So as long as your underlying remain between this corridor, and that is the payoff, which is given by this. So those are a few types of the exotic option. Oh, and then we have also what we call the variance swap. The variance swap is an option on realized volatility or realized variance. The payoff is given as, meaning the underlying is your realized variance minus, so the realized variance here, if you're not using high frequency data, say for 1 month, then what you do, if n is 30 days, then you calculate log of the asset price. This is the return. Then you square the return, and the sum of this 30 days return is your realized variance, and then you minus the strike. Meaning, if this payoff becomes bigger, if the asset price is too volatile. So now if it is moving up and down, then you have higher payoffs. Again, this is the payoff. I mean, this is a log return. And then if you just square the log return and then take this average of that, is what we call the realized variance. Okay, the VIX index, the VIX is actually the 30-day variance swap on S&P 500 index. S&P 500 is actually one of the most popular index that composed of 500 constituents. And the 30 days variance swap on S&P 500, this is what we call the VIX contract, and this is also very, very, very popular. I also put a link here if you can just go through and read it for, for basic understanding. Okay. What do we have here? Any question? Okay, no. Okay, so I told you derivatives of options, it gives you the right but not obligation to enter into a contract to buy or sell an asset at a particular price, which means it's called a strike price in the near future, which is capital T. While the forward actually gives you the right and obligation. Is you have the obligation to make sure that you exercise. But comes the maturity, capital T, you have to exercise, want it or not, because you have an obligation. But for option, you have an option to say, I can't exercise. Because of that, we know that for forward, because you have obligation, the initial value of to enter the forward contract is equal to 0. But for option, because you have the flexibility to enter that option contract, it costs you some premium. You have to pay some price. And that is what makes our financial mathematics interesting, because we want to make sure what is the fair value of the premium. Okay, I'll go through again with you. Option lead to a positive payoff for the holder, which is the same as insurance contract. But so that means to enter, it doesn't cost 0. You have to pay some amount. So the problem with pricing, if you say, I'm working on a pricing project to price some contract, you want to determine what is the free and fair value for that contract. So the problem is, the pricing problem is to determine the fair value of the premium, but the problem is, what is the payoff? I mean, the problem is the payoff, like what we have is uncertain. There is a market uncertainty. So we cannot simply discount the present value. So what you know, the option seller face the risk that he or she might not have a payout in some maturity date. So the risk management problem or the hedging problem is that the option seller might not have to pledge large amount of sum at maturity and faces a risk. Now, how can the seller reduce the risk? And this is some of the problem that we have in the risk management. Okay. Now, we look at again, I'm not going to go in detail about this, but I'll just give you a story of there's two different fields. There's actuarial science, there's quantitative finance or mathematical finance. Actuarial science it was long way back. It has been, it's sort of like an old field, but quantitative finance or mathematical finance is sort of like a new field. Okay, well, this actuarial science, because it's been there for some time, they have their pricing methodology is different from mathematical finance pricing methodology. But there is a particular example here I'm trying to give to show you that actuarial science pricing can go wrong, but mathematical finance pricing can never go wrong. So as long as we assume that there is no arbitrage in the financial market, but using actuarial science to price actuarial or insurance contract, it might lead to arbitrage opportunity. Please take note. So actuarial or insurance contract, you sell many contracts with a payoff HI, which are independent, identical distributed at a cost at time T. The cost, you just add the sum of this payoff. If you now use a law of large number, I'm sure you guys also know this, done this in basic statistics course, that the average of this converges to mean with a probability of 1. So if risk are independent. And take note of this. This only is true only if risks are independent. And then we can say the sum, or which means the total cost, is just n multiplied by the expected, which means there is no uncertainty in this involved. So actuarial pricing is now what you call, you are just discounting with discounting of expected payoffs, meaning actuarial pricing methodology is about discounting the expected payoff. This is only true if and only if we have large number of contracts. Okay, so this works if risks are independent and also the number of contracts is large, then we can use the law of large number. But typically, and this is what differentiates actuarial science from mathematical finance, is that typically issuers of financial derivatives is an investment bank that issue calls, put, barrier options, and other exotic options on, say, on S&P 500. But in general, risk associated to individual assets, meaning these risks are not independent. And already this fall out, then you cannot, actuarial pricing cannot be used. And of course, they are not independent, and that means this approach cannot be used. Okay, I have just a few minutes, but I just want to show you an example that actuarial science actually failed. Actuarial science pricing actually fails. Sorry, my apologies. So consider S is an underlying asset, and you consider a forward contract. So you initiated at time 0, T equals 0, and this is a maturity. And if you long a forward contract, the value of a contract is S capital T minus K. And now K is fixed at time 0, because if you are going to buy an asset in the future, you have to fix your strike price today. You have to fix what is the price I'm going to buy in the future. So it's always, this price is always determined in such a way that at the inception of the contract, the value of the contract is equal to 0, meaning it's fixed at initiation such that the value of the forward contract at time 0 is equal to 0. So consider the following. So now if we say K is your strike price, so suppose now at current time, you buy 1 unit of asset, which is ST, and then sell 0 coupon bond with a notional amount of K. Meaning, if you sell a 0 coupon bond with a notional amount K, what is the present value of this? The present value is K times you discount it, right? Meaning the cost, because you have ST minus what you selling is the present value. That's the value at time 0. And then what you do, you equate this to 0, and then you determine, or you compute, you make K the subject of formula in order to compute K. Meaning K is been determined by actually making sure that the value of your contract is at time 0 is equal to 0. Now, the payout at time T, at maturity now, at this time, because you bought 1 unit of stock, or maybe assets, so say security ST, this will be capital S, S capital T, this one, and then your 0 coupon bond will be K times D, but if you put T, because this maturity and this D become 1, DT is just 1, because those are discount factors at time capital maturity is equal to 1, then this is the payoff. So what you do, so if we choose K, so here you make it equal to 0, then this is equal to that, and this must be equal to the value of a forward contract at time t for maturity, capital T. This will make sure that the contract has a value T. Now, why actuarial pricing fails? So what you do, you use a replicating argument, meaning you fix the strike price. Usually what we do, because this is the strike price that makes the value of the forward contract equal to 0. But now actuarial pricing, this is how it works. The payoff is equal to this. Then what actuarial pricing do is you just discount the expected payoff. If you discount the expected payoff, this is the value for your actuarial pricing. But if you want to make sure that this contract was 0, that means if you make this equal to 0, that means your strike must be equal to the expected value of ST. But which one is right? Is it this or that? So, and that's not right. This is not right. Why? Let's see. Suppose someone is willing to enter a forward contract at some price K, which is bigger than the forward contract, or the forward price, which is that. Then one can actually enter a short position in a forward contract with a strike price K, and then in that it leads to an amount because you enter a short position, so it will be S minus ST at time T. Then you sell a zero coupon bond with maturity capital T and the notional amount ST over T, which is the same as the forward price. And the cash price, it will be ST. And then you buy 1 unit of asset. Now, in this case, because you buy 1 unit of asset, at maturity now, your realized profit will be, you have ST because you bought 1 asset. And because of this zero coupon bond that you sold, then this is the value at capital T. And this is the payoff that you get because you enter a short position in the forward to sell, then you have this. And then if you, this one here cancel with that, then you end up with K minus your forward price. In this case, this is positive, meaning this, if you look, your initial amount, you have invested nothing, but at the end of the maturity at capital T, you have a positive payoff because K is bigger than your forward price. Now, this is what we call an arbitrage. So if we see the counterpart agree to buy at any price which is not equal to the forward price, then we construct a self-financing portfolio that you don't put anything in the bank account, but in some time in the future, you realize that you have amount in your money in your bank account. The arbitrage strategy. So that's where the actuarial pricing, that means the only value for the strike price must be equal to the strike price must be equal to the value that makes the forward contract equal to 0 at inception. I'll end up here and we'll continue next week. Any question?
Sorry. Thank you, Mesias. Thank you very much. Again, for a very nice lecture. At some stage, one of the participants raised their hand and I didn't react quickly enough, but I don't remember who it was. So if any one of the participants want to
they can just jump in now and we can have a discussion.
Yes. And And I think the question in the Q&A about the probability measure, I think you mentioned in the talk, but I don't know, maybe you want to comment.
There was someone asking, is a probability measure a functional? Yes,
Yes.
It's a function that from a set of scenario that's assigning value to either between 0 and 1. Yeah.
Excellent. No, I thought you mentioned it in passing in the lecture. I don't see any other question. If anyone wants to ask a question in person, please raise your virtual hand and I press the button with, here we go.
Do you mind recommending any reference on actuarial pricing? Look at any standard books for actuarial methodology. I think the actuarial pricing really means the value is equal to the discounted payoff. And this is just to give an example. Okay, Tankeni, Connor?
Yes, Dr. Mesias, good afternoon. Good afternoon, everyone. Thank you for a very insightful lesson. This is a field that is very, very close to my heart. I've done courses in derivatives, but I still struggle to get the hang of it here and there. But yeah, obviously one day I'll get there. But then since I operate in a local authority financial setup, at times we have funds that we intend on investing. And we are actually considering other options other than the traditional call accounts from the banks and fixed investments from the banks. So we're actually looking at investing elsewhere. So for me, what maybe just if you can just give a short scenario or just clarify, or just to make it simpler, how derivatives would come into good use when we are faced with challenges like this, whereby we have funds, surplus funds that we would like to invest on behalf of a local authority, which represent local government, basically. So let's say even government at large, if I have to find myself one day in that position.
Yeah, so what you have to do is to okay, well, like I said, derivative financial contract which depends on another underlying. So what you do, you create up a product and then you define the structure of the payoff, how the local authority or maybe a financial setup will be, and then you sort of like say it, and then you define how will the payoff of this derivative be like, and then that's how you can actually set up a derivative product on that. But we can chat more about that if need be. You can just email me to chat more about that.
All right. Thank you. It's good to know that I can always knock on your door. I really appreciate that. Highly appreciate it.
No worries.
All right. Thank you.
Thank you. Thank you very much, Tangeni, for that. And someone asked whether the recordings are available. We always upload all the talks on our YouTube channel. Yeah, either you search it on under NITheCS on YouTube, or you go to the NITheCS website where we provide the link. And on the NITheCS website, we also upload the slides of the lecture notes. Yeah, so as soon as Mesias shares the PDF with me, we will upload it on the website, and you will find it there. Yeah.
Yeah.
Excellent. So if there are no other questions, then thank you very much to Mesias for a second very interesting lecture, and for having found a very efficient way to guide us through quantitative finance. Thank you very much. Thank you to the participants. And the third lecture will be again next Wednesday, 2 p.m., same Zoom link. And I'm looking forward to see you all there. Yeah. Thank you very much, Mesias. Thank you much, everyone. Enjoy the load shedding. Thank you.
Okay.
Bye-bye. Cheers. Bye-bye. Bye. Thank you.